What if I told you the 2026 crash won't destroy wealth? It'll be the greatest transfer of wealth you'll ever witness. While everyone panics and sells, a small group will quietly buy everything at bargain prices. The question is, which side will you be on? History proves it. The richest people on earth made their fortunes during crashes, not booms, and 2026 is setting up to be the biggest one yet. So here's what you need to do right now, before it's too late. Look around you. Something doesn't ADD up. Families can't afford groceries like they used to. Small businesses are shutting down because borrowing costs have tripled. Layoffs are happening quietly, no headlines, just pink slips. And housing? Forget it. An entire generation is locked out of home ownership, yet the stock market keeps hitting new highs, as if the real economy and the financial economy exist in parallel universes. But here's what history teaches us. The calm before the storm feels the safest. Right now, warning sirens are blaring across every economic indicator. Most people just can't hear them yet, but you're about to see what's actually unfolding. And more critically, how to position yourself before the reset hits, because make no mistake, the correction is coming, not from hysteria, but from fundamental imbalances that always eventually resolve themselves. My job isn't to alarm you, it's to equip you. So, when the majority scrambles in confusion, you'll know exactly where the real value lies. Let me walk you through what's actually happening beneath the surface. The economy is caught in a vice grip. The Federal Reserve has pushed borrowing costs to heights we haven't witnessed since the early 2000s. Companies that built their entire models on cheap capital are now gasping for air. The housing sector has become a grotesque parody of affordability. Median prices have divorced themselves from median incomes by the widest margin in recorded history. And consumer debt? It's not just high, it's record-breaking. People are financing their daily existence on credit cards, charging 20% interest. Meanwhile, equity valuations continue their vertical climb, utterly detached from underlying fundamentals. Picture a skyscraper being built on sand, impressive to watch, catastrophic when it falls. This is the classic end-of-cycle mirage. Euphoria drowns out caution. Investors repeat the dangerous mantra, this time it's different. But it never is. We've seen this exact script before. The tech mania of 2000, the real estate fever of 2008, and now the everything rally heading into 2026. History doesn't repeat, but it rhymes. There's a metric that Buffett himself has called the most reliable valuation gauge, total market capitalization relative to GDP. When this ratio exceeds its historical norm, you're in overvaluation territory. Right now, we're not just above the line, we're at twice the sustainable level. That's not a yellow flag, that's a crimson banner. The previous 2 times we hit this threshold, we experienced market devastation. Now consider the Federal Reserve's position. Powell has maintained restrictive policy longer than almost anyone predicted. The conventional wisdom says, once he cuts rates, we're saved. But that's precisely the trap. Look at every major recession in modern history. They didn't begin during rate hikes, they began during rate cuts. Why? Because that's when the accumulated fragilities reveal themselves. Growth stalls, earnings collapse, the entire facade crumbles. The cutting cycle doesn't signal safety, it signals emergency. Then examine the housing market. Inflation-adjusted home values in America have now surpassed their 2008 bubble peak. Let that sink in. People are signing 7% to 8% mortgages, rates not seen in decades, to purchase properties priced higher than the last time the market imploded. The mathematics are screaming unsustainability, and unsustainable systems don't gradually adjust, they rupture. And finally, the cryptocurrency space provides a perfect case study in cyclical precision. Bitcoin and digital assets follow a 4-year pattern with almost algorithmic regularity. 3 years of explosive appreciation followed by 1 year of brutal correction. We saw it in 2014, again in 2018, again in 2022. Right now, we're in that intoxicating phase where optimism rebuilds before the next potential crash. If historical patterns hold, and they usually do, 2026 could deliver another major reset, not just in crypto, but across all risk assets. When you connect these dots, the picture becomes unmistakable. Every sector of the financial system is flashing distress signals. But here's the key insight: where the crowd sees catastrophe, the informed see opportunity. Because if you understand the mechanics, a crash isn't an ending, it's a recalibration, it's a transfer. It's the moment when prepared capital meets desperate sellers. Here's what the masters understand. From Buffett to Munger, from Dalio to Marx, they all articulate the same principle through different lenses. Maximum opportunity emerges when maximum fear reigns. But intellectually grasping this and emotionally executing it are worlds apart. When markets collapse, panic becomes the dominant force. Your network tells you to exit. Media outlets broadcast apocalypse. Your portfolio turns into a sea of red. Yet this is precisely when wealth changes hands, from the reactive to the strategic. So, how do you become strategic? Preparation doesn't start during the crisis. It starts now. While valuations remain elevated, you need to position yourself the way professionals do. Consider Buffett's current positioning. As we close out 2025, Berkshire Hathaway is holding one of its most substantial cash reserves in company history, approximately half of its total assets in liquid form. Pause and absorb that. The most successful capital allocator of our era is keeping nearly 50% in cash. What does he see that the euphoric masses don't? The answer is elegantly simple. During periods of dislocation, cash transforms from a depreciating asset into optionality. It becomes purchasing power when assets are fire sold. It gives you access to world-class businesses at fractional valuations, real estate at 50 cents on the dollar, or distressed holdings that desperate sellers must liquidate. Quick note: if you're finding value in this analysis, hit that like and subscribe button. It helps more people discover this perspective. When valuations collapse, liquidity becomes leverage. But liquidity alone isn't sufficient. You need a framework. You need targets. Because the opportunity window during crashes is narrow, sometimes just weeks or months. Markets don't fall gradually. They plummet, and only those with capital and conviction will capitalize. Let me give you the tactical playbook. Step 1. Accumulate your deployment capital. This means maintaining sufficient liquidity in stable instruments. Treasury bills, money market funds, short-duration bonds, assets that preserve value during turbulence. You don't need to liquidate your entire portfolio. You need enough flexibility to act when others are frozen. Even allocating 30% to cash equivalents creates meaningful capacity. Step 2. Construct your acquisition list right now. Every market crash eventually becomes a liquidation event for premium assets. Document the corporations, index funds, or sectors that you trust for the long term. Focus on businesses with genuine profitability, minimal debt burdens, and dominant market positions. Because when panic spreads, even exceptional companies get indiscriminately sold off. That's your entry point. Step 3. Embrace strategic patience. Perfectly timing market bottoms is a fool's errand. You don't need precision. You need to be deploying capital while the majority is capitulating. Imagine having purchased Apple, Amazon, or Alphabet during the 2009 devastation, or Bitcoin at $4,000 in 2020 when obituaries were being written. Those who maintained composure during chaos fundamentally altered their financial trajectories. Step 4. Implement portfolio diversification. The investors who get annihilated in crashes are the concentrated bettors. Don't be that person. Distribute your capital across equities, fixed income, commodities, real property, potentially digital assets, if you comprehend the technology. The objective isn't predicting which asset class will outperform, it's ensuring you have exposure when they do. Step 5. Cultivate psychological discipline. This is the most challenging component because fear operates like a virus. When markets crater, human neurology screams for safety, for preservation. But the wealthiest investors have trained themselves to override instinct. They experience the same fear. They simply don't obey it. They follow analysis, not anxiety. Remember, market crashes are emotional cyclones. The panicked get obliterated. The prepared build empires. Which category will you occupy? Now, let's project what 2026 might actually deliver. Equities drop 30%, perhaps 40%. Housing values finally break their artificial support levels. Cryptocurrency markets get decimated for the fourth time in the cycle. Every media headline screams catastrophe. But beneath that surface chaos, something profound is unfolding. Buried within the panic are mispriced opportunities, the foundation of the next expansion. This is precisely how Buffett generated billions after 2008, deploying capital when terror prevented everyone else from acting. That's the mechanics of wealth creation during crashes. Readiness precedes reward. So what signals indicate we're approaching that moment? The same indicators institutional players monitor: extreme overvaluation across asset classes, dangerous leverage throughout the system, and most tellingly, investor mania. When the question shifts from what's the risk to how high can it go, that's your red flag. Examine recent years. Speculative frenzies in meme equities, real estate purchased with reckless leverage, cryptocurrency treated as casino chips, AI companies trading at 100 times earnings despite no clear path to profitability. It's the identical pattern we've witnessed repeatedly. Different actors, different narrative, same ending. When the narrative concludes, when the crash finally materializes, understand this fundamental truth. It's not market termination, it's market recalibration. Wealth concentrates further during these periods, not through fortune, but through deliberate foresight. Because sophisticated players recognize that systematic disorder actually generates recoverable value, that collective panic is fundamentally ephemeral, but intrinsic worth persists and eventually reasserts itself. Consider a concrete historical illustration. During the 2008 financial meltdown, American Express plummeted over 70% of its market valuation. The prevailing consensus declared the institution effectively obsolete. Buffett analyzed differently. He deployed hundreds of millions in capital during the absolute peak of market hysteria. Within several subsequent years, that singular strategic allocation generated billions in realized returns. Not from prophetic vision about timing, but from grasping one immutable principle that separates successful investors. Superior assets with genuine competitive advantages always resurrect themselves over time. Inferior businesses with structural flaws vanish permanently. Your primary task is developing discernment between these categories, and this analytical approach isn't exclusive to billionaire class investors. Retail participants can deploy identical methodology at any scale. Whether you're operating with $1,000, $10,000, or $100,000 in deployable capital, the underlying logic remains precisely constant. During systematic dislocations, quality assets get mechanically marked down alongside everything else. And if you maintain emotional rationality while others psychologically unravel, you systematically prevail. So when 2026 correction arrives, and it will arrive, you face a binary choice. Option 1, succumb to panic, liquidate holdings, merge with the stampeding herd. Option 2, recognize it for what it authentically represents, the periodic reset mechanism that global markets execute every few decades. It's the atmospheric purge that clears systemic excess, the controlled burn that eliminates dead growth but enriches the soil for what emerges next. Those who genuinely comprehend this dynamic, who've conditioned both their psychology and their capital structure, will emerge fortified, wealthier, and operating with greater autonomy. But waiting until onset is catastrophic planning. Preparation equals wealth generation. panic equals wealth destruction, every historical crash rewards the methodical and punishes the reactive, and methodical behavior commences immediately. As we advance toward 2026, internalize what we've covered. The warning signals are undeniable. Grotesque valuations, systemic leverage, institutional overconfidence, an economic structure extended beyond sustainable limits. But opportunities exist in parallel. Accumulate liquidity now. Construct your target list. Monitor with patience. And when dislocation strikes, execute with conviction. Because while the masses lament paper losses, you'll be systematically constructing lasting wealth. That's the mechanics of using the 2026 reset advantageously, not through random chance, but through deliberate preparation, through sustained patience and decisive courage when collective resolve evaporates. Every crash inscribes a new chapter in financial evolution. The singular question, will your actions merit prominence in that narrative? Because after the volatility subsides, those who operated from fear disappear from memory. But those who operated from strategy become the documented cases of individuals who transformed their generation's largest market disruption into their defining wealth-building event. So what's your perspective on this analysis? Share your thoughts in the comments below. And if this framework resonated with you, hit that subscribe and like button. It extends this conversation to others who need to hear it. Just a reminder, I'm an economist providing analysis, not a licensed financial advisor offering recommendations. This content serves purely educational purposes. Your financial decisions and their outcomes remain entirely your responsibility.